Hey, good afternoon, good day, good morning. Whenever you listen to this, my name is Dave Stein. Welcome to the Rick and Dave podcast. I'm joined by my guests, Rick, Bame, and Dale. Rick, why don't you give us a little shout?
Rick Bame, I'm owner of R&K Property Investments as well as Enterprise Services, a commercial lending partner with Investion. And glad to be here. We got Dale for a part two
Part
today,
two.
and I'm
Yeah.
so excited.
I am
Excellent.
too. I am. So if you haven't watched part one, go back and check that out. But um, Dale really brought us up to speed on what buying and investing in notes are. And today, correct me if I'm wrong, Dale, but now it's talking about kind of non-performing notes.
Yeah. So that first one is just kind of an introduction to the concept of what the heck is note investor? Who are note investors? What do we do? And why do we exist? And maybe there's a lot of, I still to this day, it's been around for decades, but still to this day, I meet people that have been real estate investors for decades, and they've never heard of a note investor. They didn't even know we exist. I talk to people in the mortgage industry, and they don't even know that note investors exist. So yeah, that was kind of an introduction to note investing. And today I'm going to be sharing a strategy, a more advanced strategy that talks about non-performing notes, NPLs, as we call it in the note industry or in the mortgage space. Um, and these are coming from lenders, banks selling assets off of their books, non-performing assets, note funds that are selling assets off their books, loan servicing companies. It can come from a variety of sources. But the reason I wanted to share this one is because, yes, it is relevant to note investing world, the non-performing side, but it's also got some things I shared with Rick that real estate investors might find interesting. And that's one of the reasons I say that I think every real estate investor should know a note investor and vice versa.
100% agree.
Yeah.
Even I think just last time, and I won't speak for Rick, but I feel like we were both like there's
That's
just
cool.
how can you're a real estate investor without being a landlord? And that's
Yeah.
just such the opposite of what is traditionally put out there is start wholesaling and then buy a
Yeah.
duplex or buy a property, rent it out, and just a whole nother universe in notes.
Yeah. The way we put it, we choose to be the lien lord, not the landlord. Um,
I like that.
and it's interesting because it doesn't even need to be the real estate investing world, just the home ownership world, real estate in general. And yes, real estate investors are in there. And two, unless they're buying all cash or they got cash to buy on their own, every acquisition creates a debt. And then nobody really thinks about what happens to that debt after it was created. It's there, but nobody really thinks about it other than the fact that it's a monthly payment. And so that's what hopefully I can introduce to your audience is, yeah, there's an entire debt side of real estate that's a multi-trillion-dollar industry that's very, very liquid.
For sure.
Dale, I was on the phone this morning on a follow-up call with somebody needing a commercial loan or potentially needing a commercial loan. And he just casually mentioned, he goes, "Oh, I'm a note holder." He was wondering about using his notes for collateral.
Yes,
Um,
yes.
and I thought, boy, what timing! I'm talking
Yeah,
to
right.
Dale in about 2 hours.
Yeah.
So
Yeah, that's a strategy too, right? So you hold a portfolio of notes. It's an instrument, right? It's a debt obligation, and it's demonstrable income. Yeah, you can borrow against it. You can borrow against your portfolio. There are terms that like hypothecation. You can do hypothecation with the note portfolio. And I know note investors too that maybe they create a portfolio of 20 single family homes, and then they decide, hey, I want to move over to multifamily. They find somebody that has a multifamily note. They said, I'll swap you, right? As long as there's comparable values. So it's liquid in that extent too. We just trade back and forth.
That
You
makes
don't
sense.
see that too much, but you can do it. But yeah. You're a person that has a portfolio of notes. That's definitely lendable against.
interesting.
Yeah.
Yeah.
So tell us about non-performing notes.
Yeah, get us
As
kicked
an
off.
investor, as an investor that's not familiar with this, when I hear unperforming notes, I think of bad
Right.
bad note,
Yeah, bad
so
debt,
it
huh?
has a negative connotation. Explain to how this can be a very attractive investment.
Yeah, I'll give you a brief explanation, and I'm going to jump into a presentation that kind of shows you a strategy that I follow. Because also, when you think of non-performing home loans, owner-occupied single family. Let's just stay with, single family owner-occupied, mom and pop, 2 kids and a dog, kind of home loan. And you think of non-performing, you think immediately for it. And I don't want to overgeneralize when I say real estate investors, but normally that would conjure up the idea of foreclosure.
Foreclosure, 100%.
Right. And then
That's
people just
immediately what I thought.
yeah, immediately go to foreclosure. And yes, that is an option for the debt holder, but it's not the only option. It's not the only strategy. I'm going to share you a strategy that I follow that actually has something in it for real estate investors, but also, so to answer your question, Rick, when a bank is holding a non-performing asset, and we've been, and when I talk to real estate investors, especially real estate investors that maybe historically they went after REOs, and if you have people in your audience who aren't familiar with REO, that's real estate owned, means the bank has taken it to foreclosure, it didn't sell, and the bank took it back. So that's real estate owned REO. It's a bank held property. And then they go to an auction to buy, they maybe talk to a bank, hey, do you got any REOs that you're willing to sell? Or they go into foreclosure sales and they're bidding at auction. And they just haven't been seeing these things at auction that much. And I hear that there's not a whole lot of foreclosures. Well, that's because over the last few years, the banks have been holding on to these non-performing assets and keeping them in an asset column as soon, and like they're holding them in non-accrual status. When I look at the FDIC filings for banks that I follow, I see these loans sitting in non-accrual status. In other words, they're kind of in purgatory. They're not performing, but they're not an REO yet. And it's called non-accrual. They're just not doing anything. But here's the thing. When a bank moves it from, say, a non-performing loan status or non-accrual over to REO, it goes from the asset column to the liability column. And they haven't been willing to move things over to that liability column. So they're just letting it sit in non-accrual while these delinquencies build and build and build and build. I've been looking at some bank tapes lately within these last couple of weeks where I'm seeing loans that have not had a payment since 2018. So that's seriously delinquent. Seriously delinquent.
So let me jump in real quick, Dale.
Yeah.
How is, because again, new guy, I think non-performing, I think foreclosure, I think bankruptcy, some sort of calamity event at some point. I mean, we're talking 6 years now that this thing hasn't been paid on.
Correct.
At what point does it just it becomes dust, or just it becomes bankrupt, or what does that look like?
Yeah, right. And of course we have to stay, bankruptcy as a broad term. Then you got to start dialing down into the individual state that you're talking about,
and the chapters.
So what's the foreclosure laws in the individual state that you're dealing with, right? Texas is going to be much different than Illinois. So you really got to understand whether it's judicial foreclosure, non-judicial foreclosure. What are the redemption periods? Are you dealing with multiple owners that, little tricks that people can do if there's multiple owners of a property? One person can file for bankruptcy. That bankruptcy expires. The next person files for bankruptcy. And they can just drag these things out. So yeah, there's that's going on out there. But yeah, so bankruptcy is our recourse, our ultimate recourse. But let me jump into my presentation. And I'll kind of show you a strategy that I follow here at Terravest Capital Partners when it comes to non-performing loans.
Perfect. Rock and roll.
Entire screen here. And all right, you guys see this?
Yes.
Yep.
All right, let me move all my little Zoom things. Can I move that out of the way? There we go. Move that out of the way. Okay. So this is a strategy that I applied in non-performing loans. And again, these are loans that the banks are now sending out. It's called a tape. when they send out basically an Excel spreadsheet of non-performing loans that they're moving off of their books. They're getting ready to liquidate these assets. They send it to a note investor like myself. And as we talked about, Dave, in that first session, you asked, where do you find the inventory? This is even more of a situation where it's a relationship. I've built a relationship with either a note-based fund or a bank, somebody that does special assets, responsible for special assets at a bank. They said, okay, here are the loans that we're selling this month, this quarter, whatever. They send us an Excel spreadsheet called the tape, and then we just start going through it and see what we want to bid on, and then submit bids. And once we submit a bid to them, if they accept the bid, that starts our due diligence period, where now they send us what's called the collateral file, which is everything about that loan that the bank knows. The servicing history, everything. When they send me the bank, I see everything about the borrower. I see their FICO score. I see their debt to income ratio. I see everything. You know, the kimono's open and I can see everything about that borrower in that particular loan. So, absent of going straight to foreclosure, many of us that do non-performing loans, we really do want to keep the owner occupant in their home if we possibly can. Sure. That's always the first option. And to keep in mind, when we're buying non-performing assets, we're buying it at an extremely deep discount, even like to fair market value or something like that. And so I'm going to jump into this. Do I got to click things? Yeah, I got to. Okay, so here's a general summary. I'm buying non-performing or NPLs, non-performing loans directly from lenders, traditionally banks, can be other types of lenders too, but banks, note-based funds. These are funds that have been buying loans from Fannie and Freddie and the large GSEs, and even loan servicers. So this is institutional grade paper, meaning it's Dodd-Frank compliant. Some of the other paper that you can run across out there. When I say paper, I'm talking notes. Notes, paper, we call it paper. Seller finance notes. If somebody sold their home and they carried back paper, chances are they didn't underwrite the borrower through an RMLO or an MLO. They just didn't structure it very well. And we always have to worry about whether or not that is whether it's Dodd-Frank compliant. And Dodd-Frank is I would suggest anybody that's in real estate. I don't care if you're a real estate investor, or for sure we know about it in the note investors, but real estate investors really need to understand Dodd-Frank. What does it mean for something to be Dodd-Frank compliant, especially if they're doing creative financing and seller financing. But this is institutional grade paper, so we know it's Dodd-Frank compliant because it's been underwritten by an MLO, or an MLO is a mortgage loan originator, or an RMLO. They call them RMLOs down south. That's a residential mortgage loan originator. But we're buying these at steep discounts because they're non-performing. Presently, the discounts are around 80% of the legal balance. So you got a borrower that's behind in payments. Let's say it's 2 years behind on payments. There's been penalties and late fees and things like that get added on to those payments they've missed. And you end up with what we call the legal balance of the loan. There's unpaid balance of a loan, and then there's the legal balance of the loan. So the going bid is around 80% of legal balance. And typically the way it works out on the spreadsheets, when I run the numbers, it usually means that we're at about 50% of the fair market value. And that's a fair market value based on the lender's original BPO. And if somebody's not familiar with BPO, that's a broker price opinion. It's just a way of getting a pricing estimate that's accepted within the lending space. So that's based at 50% of fair market value based on the lender's BPO. And when I do get these loans, typically the bank has started foreclosure, but they don't complete them. They're good at starting foreclosures. They're just not good at completing them, because once they complete them, then they got to deal with it as a foreclosure. So they'll start the foreclosure, then they'll start putting it on their tapes to sell it, and then they'll sell it to investors like myself. So they got, the horses out of the gate on the foreclosure. And it's up to us whether or not we're going to continue down that path. So here's what I'm typically looking for. I'm looking for first position liens only. Yes, you can buy second position, but that's not this strategy. This is first position liens only. I'm looking for owner-occupied or tenant-occupied properties. I don't want vacant. Vacant becomes a different strategy, right? Remember, I'm trying to get the borrower reinstated and get them back into making their monthly payments. Well, if it's vacant, that's kind of hard to do. They've already moved on. They've left. the property. So owner occupied or tenant occupied, and I'm going to address the difference between owner occupied and tenant occupied in the strategy that I use in the next slide. I'm looking for borrowers at anywhere between 12 to 24 months delinquent. Once you get 36 months or more, it's kind of hard to do a reinstatement because it is so far behind. It's worth a conversation, but as far as when we talk about buy boxes, it's at 12 to 24 month delinquent. So here's the first part of the strategy, leg one of the strategy, and this is the part that Rick got kind of excited about when I told him about. And I think this is why I think it'd be good for real estate investors to know note investors. And as I said, our primary objective or the initial objective is to reinstate the borrower, try and get the borrower back on track. Now, why would I want to get the borrower back on track? Well, if I bought the note at a steep discount because it was non-performing, and then if I can get the borrower to start making payments again, start making their P&I payments again, my ROI is significantly higher than the original face value of that note, significantly higher. And again, I bought it and I'm holding it at probably 50% of fair market value. And the tape I was just looking at that I got earlier this week, 80% of fair market value would have meant that I would hold these properties at 46%. I would have been holding these properties at 46% of fair market value. So the first part is to try and get the borrower reinstated. So how do we do that? Or we call it rehabbing the loan. I call it rehabbing paper, not properties.
Right.
So we need to know that the borrower is serious about reinstating their loans. So in a situation, let's say the borrower is under 2 years behind on their monthly payments. I'm going to ask them to bring 4 months of monthly payments, 4 months of their P&I payments to the table, just to demonstrate that they're serious about this. They got to put some skin in the game, right? We're not just going to do a reinstatement without them showing any level of commitment. Now, so yeah, let me talk first about that difference between owner occupied and tenant occupied. So owner occupied, that's where I'll be looking for like those 4 months of P&I payments that they're going to bring to the table. If it's tenant occupied, let's suppose I got a single family home that's tenant occupied, which means that an investor is holding that paper. If they've been collecting rents for those 2 years, but hey, they have not been making their payments, that's kind of not cool. Right? So I'm going to be a lot less flexible with a landlord or somebody that holds rental property that's collecting monthly rents, but they haven't been making their payments. I'm probably going to ask for 6 months or more of monthly payments, depending on how far behind they are. Right? So I'm going to be a lot less flexible with an investor in that situation.
For sure.
But so once the borrower, I would structure a repayment plan and I submit that plan to my loan servicing vendor. It's the loan servicing company that actually executes the reinstatement. I don't ever talk to the borrower. I don't have to. I have a loan servicing company that does that for me. They communicate with they try and reach out and connect with the borrower, explain the repayment plan, all that type of stuff. They set up whatever, how to collect the payments. Because once I buy a note from a lender, letters go back and forth between the former note holder to the owner occupant, and then from us to the owner occupant, and owner occupant notifying them that that loan has changed hands, and now you're going to be dealing with this company. Chances are anybody that's a homeowner, you may have seen letters like that over the life of your loan. Maybe don't remember it, but it's probably happened. So I come up with a repayment plan. Doesn't have to be very complicated at all. Submit it to my loan servicing partner, and they will follow up and execute the repayment plan.
And Dale, sometimes folks get frustrated because they don't want a middleman. They don't want, I would just like to talk to the guy, right? I hear that as a real estate agent, man, if I could just talk to the buyer or the seller, it'd be so much easier, which is true. There is layers of communication, but using a loan service provider, to my knowledge, that protects both parties so
Very
that
much so.
You're not getting into this weird verbal he said, she said. Is a third party that's neutral, that's saying,
Here's what the note holder said. Here's what the borrower said. Do you guys come to an agreement? Yes. Okay, here's the plan going forward. Is that
Absolutely.
is that one of your
Absolutely.
biggest reasons?
Yeah, spot on. Well, that's a big reason also. I mean, they're making notes. That all goes into the servicing history of any particular loan. Plus, once you get into these kind of conversations, you got to be careful from state to state, because now you start getting into the role of a debt collector and licensing for debt collectors. So when you're working with a licensed loan servicer, you're covering your base on the licensing side of things. You don't really want to take the lead on that kind of stuff and not be licensed, is what I'm saying.
Yep, for sure.
And that's kind of everybody in my orbit is kind of the same position on that. You want to use a licensed loan servicer. Plus, we do this because we want passive income. And once you start inserting yourself in the middle, you are no longer passive.
Yes, 100%
right?
agree. Yep.
So then after we have 1 year of on-time payments, it now becomes performing. We call it an RPO, a re-performing loan. And now what can we do with that? Well, now that we have a performing loan in our hands, we can turn around and resell it as a performing loan to another note investor that's simply going to hold the note for the yield. Now, we bought it at a steep discount because it was non-performing, but we can resell it at a higher value because it is performing. So we're flipping the paper in that situation. We rehab, just like you rehab a house and sell it. We're doing this with the loan or with the borrower. We rehab the borrower and we're going to sell it at a higher value.
Dale, can I how often are you able to get the notes performing when you start it with the non-performing? Is there a general rule of thumb?
General rule of thumbs, but we're kind of numbers that we throw around is about half the time. It depends on how delinquent they are. I mean, every note, every loan can become very unique because you're dealing with people, right? Human beings. But if we were looking at it statistically, about half of them you can get re-performing, 25% you got to do some other strategy to take the property back, and about 25% of them end up going to foreclosure and go to auction.
Is it similar to investing in real estate, Dale? We tell folks you need to have an exit strategy. You need to know what you're planning to do with this property. Are you going to hold it long term? Are you flipping it? Is the same with notes?
Yeah. So this is we're kind of going down that path of what the potential exit strategies for this are. Perfect. So let's say this step one, we're able to get the borrower reinstated. They start making on-time payments again. And sometimes it's just a matter that the person got behind. Maybe it was they got behind a COVID, or they lost a job. Sure. And now a lot of different, not every delinquent borrower is a bad borrower. So they could have a reason, but they just ended up getting so far behind. And when they were dealing with this bank that was this large institution, it was just an entry on a spreadsheet. There's nobody that, not a loan servicer like I would be providing to them where they can actually talk to them and say, all right, what happened? Why'd you get behind? And then we say, okay, we understand you got behind. Can you bring 4 payments to the table and let's get you on a repayment plan? Maybe it's, can you bring 4 payments and then can you afford $200 extra a month above your P&I payment to try and bring some of that, your arrears, back in?
Bring it down.
Whatever. Yeah. But so here, exit strategy number 1 is now we've gotten this loan reperforming. We can sell it to another note investor, sell it at a higher value, and arbitrage the difference between the discounted prices. Here's another exit strategy that I would follow. Now that we have a performing loan on our hands, we could actually turn around to one of our IRA or self-directed IRA investors and say, hey, now this is a performing note. You can buy it in your self-directed IRA at a 10% annualized yield and hold it for the next, 10 year, how many ever years are left on the loan until maturity. Sure. Now they can have a completely passive performing note paying monthly into their self-directed IRA, and they're doing nothing. They have no involvement whatsoever. And that addresses the whole self-dealing, right? You can invest out of a self-directed IRA, but you cannot manage the property. You can't do anything. You got to be completely passive. This provides completely passive, again, because your loan servicer is actually managing the loan. You just, like the performing notes I have, My loan servicer does it. All I see once a month is I just see the deposits coming into my checking account. So it's completely passive. The other thing we can possibly do is roll over the note into the Terravest Reg D fund, which I'm working on, which is going to be a typical fund. This is going to be a debt fund, not an equity fund like a syndication or something. But just roll it over into the debt fund, and then we can hold it there as a performing note and just hold it for yield.
So you said a lot that I think, myself included, syndication, equity fund, debt fund. Run us through on a 101, like what do all those things mean?
Yeah. Okay. Sorry. So when we think of a fund, we think of let's just stay with real estate. Most of the time you hear about a fund in real estate, it's a group of investors that come together. They invest into a multifamily syndication. It's usually multifamily. That's what we hear about most. The investors are the limited partners. Then you have a few people that are running it and managing the property. Those are your GPs or your general partners. And their exit strategy would be, well, we're going to buy this multifamily unit. We're going to do some improvements on it, get the rents up, improve the NOI or the net operating income. And in year 7, we're going to do a cash out refi. And in year 8, we're going to sell the property. That's our exit strategy. And we close down that syndication. But most funds that deal with real estate are buying the asset. They're an equity fund, right? They're getting equity in a piece of property. And then there are debt funds like the Terravest fund, which we're buying the debt. We own the debt inside that fund, and we make our yield by collecting the monthly payments on that debt. So it's a debt fund. Yeah.
Thank you.
The whole world of funds is a fascinating space. Yeah.
It's Pandora's box. Like, there's just so much to it.
It really is. And, I kind of, if I talk to people today that are looking at investing in a multifamily syndication, the first thing I ask them is, where are you looking at investing in this multifamily syndication? Please don't tell me you're going to do it in Austin or one of those Sunbelt towns, because I said, I tell them, and I'm honest with them. I said, if you're going to put your money into a multifamily syndication in like Class A new construction or something like that, in one of these cities that were really booming during COVID, you really missed that boat. And now those loans are really struggling. The syndicators are more frequently calling their limited partner investors saying, we need you to bring more money to the deal just to keep it alive. And that's called a capital call, when they do a capital call with their investors. And here's the thing with a debt fund, like an equity fund, like a multifamily syndication, it's based on pro forma numbers that, hey, if this works this way, this is how much money we can make. That internal rate of return and everything, that the fancy terminology that they throw around. But all that is based on projections. Nobody knows what's going to happen to future rents. Nobody knows what's going to happen to future insurance costs. Nobody knows what happens to the holding costs, utilities, and all that kind of stuff on these assets into the future. All you can do is make projections about what it is. But here's the beautiful thing about a note-based debt fund. We know what we're going to be making every month because we know that's defined by the promissory notes that we own.
That makes sense.
There are no surprise. There are no capital calls. There's no surprises. We don't pay insurance on anything. We don't. It's strictly, it's as simple as that. We know exactly how much we're going to make, assuming our borrowers continue to make their monthly payments on the note. So very simple. All right, I'll move on. I want to respect everybody's time. So this is step number 1: try and reinstate the borrower, rehab the loan. But what happens? Oh, let me just say this too: we do not modify loans. We try and reinstate loans. We do not modify loans. And you might hear the term loan modification. Why do we not do a modification on these? Remember on the first slide, I said the banks have typically started a foreclosure. So this borrower is in active foreclosure. If you modify the loan, you restart the clock on the foreclosure. You reset it. We don't want to do that because we don't know if the borrower is going to continue on with the monthly payments. So we keep it in foreclosure status, reinstate the loan. We do not want to modify. That make sense?
That makes a lot of sense.
Cool.
Yep.
Okay.
Yep.
And again, not you're not doing it because you don't because you think the person's a bad person. It's a business decision to like, gosh, if they're still not going to pay, even if we modified it, well, then you just delayed the inevitable.
Absolutely. Absolutely. You know, it's time to move on, you know, just kind of,
Correct.
yeah. Yeah. I mean, you give them a fair shake, and if it doesn't
Right.
work, you just got to move on. So yeah, we
Yep.
want to keep the foreclosure in place. But what happens if we can't reinstate the borrower? We got a plan B for that. This, we cannot reinstate the borrower. This is where the real estate investor might find it interesting. First thing I'm going to do is I'm going to try and find an experienced subject to investor that could assume this loan. Now, that might sound kind
We
of
happen
weird.
to know a few of those.
Yeah, exactly. So this might sound a little bit weird. It's why would you want to do that? Well, remember, my objective is to get this loan reperforming. So, you know, call and I would want somebody that's done a few subject twos, so it's a smooth process. They know what to do when it comes to insurance and all that type of stuff. And yeah, they can do it subject to. We just call it a loan assumption. It's nothing fancy. It's simply a loan assumption. But chances are some of your listeners, because I run across this with real estate investors all the time when I talk about note investing, chances are some of the people say, well, how can you do that? What about the bank? Well, the bank lets you do that. And that's kind of when I said, well, you're not absorbing what we're trying to share here, because we own the loan, we are the bank.
Yep.
So in my opinion, I don't care who pays, just pay. And if you're making, and so if you have an investor that can step in and start making those monthly P&I payments, keep the insurance up to date and what have you, hey, I'm fine with that. You know, have at it. We'll call it assumable, because we don't need to worry about, was it originally created as an assumable loan? It don't matter. That loan's been sold. I own it now, or Terravest owns it now. Yes, it's assumable. Now, what if that doesn't work? Well, we can always go to the next one, and that's cash for keys or deed in lieu. Both of these, I mean, the loan, cash for keys, deed in lieu, still going to help the owner, the borrower, keep a foreclosure off their record.
If we go back to a assumable loan, you own it. You know, in current Fannie Mae, Freddie Mac, in current traditional mortgages, there's a due on sale clause if title transfers without, you know, the lien holder knowing, or when they find out they have the ability to do that. Do those same principles fall into place when you're buying these notes?
Well, the terms of the loan are still in place, because that hasn't changed, right? The loan has not been modified. The original loan is still in place. So yes, there would still be a due on sale clause, but because Terravest, because we own the loan, you do not need to worry about due on sale.
Yeah.
Okay. If you structure it right, you make the monthly P&I payments, you keep the insurance, you get the loan performing again, there will be no due on sale. Matter of fact, you know, if I run across that, I'll actually I'll be looking for investors to send these to and say, hey, here's the phone number, here's the name. I know all that stuff because I got the bank tape on them.
Yep.
Here's their contact information. You know, my loan servicing company's done any skip tracing to find the people, anything like that. Here, subject to person. Go talk to them and get this dang thing reperforming. So yeah, no due on sale.
Well, Dale, if I hear you correct, by you owning that note, it actually gives that homeowner more options than it would be otherwise, because that unassumable loan, then it essentially becomes assumable. And wouldn't that give the homeowner more options to get out from underneath this?
Yeah, to that point. I mean, even if they go out and they find somebody to assume the loan, I don't care.
Yeah.
I think, Rick, I think of, you know, the sub 2 community that we are within in Pace-More being just one of the big headaches or risks of acquiring property subject to is a bank initiating the due on sale clause, which, Dale, we normally say, for the most part, most banks are similar to you. You don't care who's paying. You just want the money. And if you're getting the money, then life is good. There are
Mhm.
some that are a little more finicky, like, well, we haven't underwritten this person, we haven't, XYZ, but what an amazing opportunity to work together all for the same, like at the end of the day, all of the goals are to help people, either
Yep.
helping investors or helping homeowners get out from under bad situations.
Yeah, and push come to shove, if it doesn't work, it's also about getting somebody that's deserving of that property in there. So to your point, I mean, we if we can help people, it's just a smoother process all
For sure.
around. And yeah, I mean, the last thing we don't want, abandoned properties in our communities and things like that. So yeah,
100%.
yeah. So
If I'm in the market for a subject to home, I want to be sitting across the table from someone like yourself because you have such good insight and access to the properties that are, in distress. Whereas as an investor, you can come in and really help those homeowners out. You know, why have historically not, people looking for subject to worked more closely to note holders? Is it
yeah,
just
great
because?
question. I mean, maybe we're blazing new ground here. Um, you
Love it.
know, it's also because, again, it's only recently, within the last couple of months, have we as note investors started seeing these non-performing notes coming from the banks. They've been sitting at the banks. They, just sitting there. And again, when you're special assets or something like that, it's just a spreadsheet that you're responsible for managing. It's not, it's an entry on a spreadsheet. And now once it gets sold off to an investor, now because we are investor class, both real estate investor and note investor, we have an investor class mindset when we're dealing with these assets. We said, well, now how do we make this investment pay off? There's really not a big incentive at the bank for that special assets manager to do much with it, other than I got to find somebody to buy these things. So yeah, it's just finding a better home for them. And one of the reasons that I was happy to be invited back to your podcast is because I think this is something that is going to be, this is a state of the market which is starting to present itself.
Very
And
much so.
it's going to just become more and more. And I'm going to show you on some future slides why I say that. But I think the opportunity is just starting, Rick, and we got a long ways to go. So there's going to be plenty. So your listeners are at a good place at a good time to get a leg up on everybody else on that.
Awesome. Awesome.
Okay, so like I said, if that doesn't work, we can always take back the property using cash for keys or deed in lieu. And then we just exit at the sale. We just sell the property to another real estate investor. Remember, we really don't want the property. We just wanted the ROI on the debt. So we'll just sell it to a real estate investor. We got it at such a steep discount. We can give you, TJ Maxx pricing on the house, and or just list it and sell it to a young couple that wants to do some sweat equity, and we can list it for much lower than the other houses that are being listed in that area. And it's a weekend project kind of house. Okay, so that was plan B. So if plan B doesn't work, well, there's finally foreclosure. We still have that foreclosure that's sitting there, so we can go into foreclosure or continue with the foreclosure. That means we simply take it to auction for the legal balance. And remember, we bought it typically at 80% of legal balance. So we have 20%, if you want to call it that, we're at a 20% equity on legal balance. That's not equity on fair market value. That's legal balance, right? So we're probably, 60% equity. I mean, we're pretty high equity when it looks to from a fair market value standpoint. So we send it to auction and sell it for the legal balance. We're made whole. If it doesn't sell at the auction, we can always take the property back, resell it to an investor, or we could hold it because we bought it at about 50% or less of fair market value. So we're already in a very attractive position there. Holding it would probably be the last thing. It would really have to depend on the property, right? All right. So I just want to share some key statistics. So that was my strategy. Any questions on the overview of the strategy? Pretty simple.
Yep.
All right. So what are we really looking at here? So these are numbers from earlier in 2024. These are mortgage statistics from 2024. Americans own $12.52 trillion of mortgage debt and there are 85.35 million mortgages. Using their numbers, if 3.35% of those mortgages are delinquent of at least 30 days, and a lot of them are a lot more than 30 days, but if 3.35% of those 85.3 million homes are delinquent in 30 days, that gives us 2.85 million delinquent mortgages in the United States. Plenty of inventory for non-performing note investors. Plenty of inventory.
That seems scary.
It should be.
And especially as you know, Rick and I are on, brokers in the commercial side, and we're expecting 1.5 trillion in the next 2 to 3 years to need to be refinanced in the commercial side.
Yeah.
This is we're not saying there's a bubble, right? We're not saying the world is coming crashing down, but there are indicators that are saying there may be some opportunities for investors. There may be some opportunities for homeowners to get help now before it gets to this point. But yeah, I'll let you keep going. It's just when you see that number, you're like, holy smokes, that's especially in. Go ahead, Rick.
Oh, I'm sorry. I didn't mean to interrupt you. Are there notes on the commercial side? I apologize, Dave. I didn't mean to step on you there.
On the commercial side, well, it's funny you mentioned that, Rick. Last night I was sent a lot of defaulted multifamily in Beaumont, Texas. I was also sent defaulted multifamily. This is a 5-unit in Miami. Yeah, there's a lot of it, Rick. Now, the ones I was sent in Beaumont, well, both the Beaumont, Texas, and the Miami, these were privately held. These I didn't get the full detail. Literally, I just got them last night. Somebody sent them to me. I haven't been able to dive into them much, but these look like these are coming from hard money lenders that were selling it because they did a hard money loan on a rehab of these properties, and now they're foreclosing. They're in active foreclosure. So yeah, absolutely, multifamily for sure. They also sent me some office in Houston. Was it Houston? Yeah, but I said, not too many of us are really looking a lot at office right now. So if you have people that want multifamily in Beaumont, Texas, I know where there's a lot of it. Now, one of my connections down in Texas says, yeah, Beaumont, that's a pretty rough area. So yeah, and if you have listeners that are down in Beaumont, I'm sure they live in a lovely part of Beaumont and it's lovely where they're at, but where these multifamilies were, it was pretty rough. But yeah, definitely happening. Here in Minnesota, which as some of your listeners may or may not know, I'm in the Minneapolis market. So I watch the banks that are based in Minnesota. Every quarter, I look at their FDIC filings. So I know exactly what's happening in their loan portfolios. And in the second quarter, yeah, from first quarter, yeah, because I'm getting third quarter numbers now. Those are coming in now. So second quarter numbers, there was a massive move of multifamily loans going from 30 to 89 days late over to that non-accrual bucket. A massive move. So there's a lot of multifamily debt sitting in non-accrual, and I'm just waiting for that stuff to start showing up on the bank tapes, and they'll start, getting that stuff off their books. So, Rick, if you want multifamily, just let me know. So this is some information. One of the folks in my network shared today, and I thought I just literally threw this in after he shared it this morning. This comes from Adam, and this is 2024. I got the source down at the bottom. It's Adam's 2024 Home Equity and Underwater Report for the second quarter of 2024. And this shows that cities with the most, I don't want to use, maybe right now at this present time, calling homes underwater is like politically incorrect. So I'll say the borrower is upside down. But here they are. This is 750,000 mortgages that are, according to Adam, seriously underwater. Not late, seriously underwater. They are negative equity on these properties. And this is just the top 10 states. This isn't the entire country. Mm-hmm. So, when I get into conversations with real estate investors, note investing versus real estate investing, it doesn't have to be an either or, but when we compare the two, they often say, well, you don't own the property, so you don't get the appreciation or you don't get the equity. And you're right. We can't leverage the equity, but the equity does protect our investment, right? We do realize the value of the appreciation of the property because now the collateral is even stronger for the loan that we hold, but I can't do anything with it. But I mean, those of us that have been around long enough know that real estate is cyclical, just like any market. And there's ups and downs. And I see a lot of people that have gotten into real estate investing that just assume that appreciation is always going to be there. Well, these people have realized these 750,000 homeowners and they're now in negative equity, and this continues to grow. So I get it, the idea of investing for future appreciation. I would say appreciation is a nice bonus. I'd rather invest for cash flow than appreciation, and just be glad I got appreciation when you get it. So
yeah, I think that's a key distinction, that appreciation is good, right? It's a reason that real estate is a very popular investment when it comes to wealth building. But when you talk about investing in it, depreciation of the asset is usually the bigger ticket to actually be the landlord and have title, compared to owning the debt, where you can still participate in appreciation. You just can't, to my knowledge, you can't take the depreciation.
No.
Yeah.
We don't get that. Yep. So this was just something new, and I'd say just check it out if you want to look at it. Just really look for Adams 2024 home equity. But this should also, like for me as a note investor, which I'm playing the other side of the coin and non-performing, this tells me the states I probably should be paying more attention to. Right? Because if they're non-performing and the borrower is upside down in their equity, I can get it at an even steeper discount because now I'm bidding based on the asset value, not the legal balance.
Right.
So I can even get it at a deeper discount. So to that point, this was just last week. Fannie Mae just sold 1,675 deeply delinquent loans for a total of $280 million of unpaid balance. This is their 25th non-performing loan sale. And this is where the funds go. The fund will somebody will come in and buy all 1,675 loans, and that's how how they find their way on the secondary market. Then the fund will start sell some of those assets out of their portfolio. So these auctions are happening quite frequently. Here's an example of a loan tape that was sent to me on Tuesday. This is 18 defined as non-performing loans. 18 of them. There weren't any in Florida this time, which is kind of surprising. I've been seeing a lot more in Florida. And example of, hey, there's one up near Chicago. I wouldn't have any interest in Chicago whatsoever. Probably not New York either because of foreclosure laws and what have you.
Sure.
And this had a total fair market value, an estimated fair market value based on lender's BPO of $4.6 million. The legal balance on all these loans together was $2.6 million. So the legal balance was 56% of the fair market value. Not bad. All right, even if I bought at legal balance, that wouldn't be bad, right? I'm getting these assets at 56% fair market value. But again, as I mentioned earlier, because bids are typically around 80% of the legal balance, that means that if I were to buy all of these, I would be in at 45% of fair market value. Interesting note about about half of these, like the ones down south for sure, Louisiana, Alabama, Georgia, the borrower is actually making monthly payments. They're in Chapter 13. They're bankruptcy Chapter 13 and making court-ordered monthly payments. So as somebody that's buying non-performing debt, remember, my first objective is to try and get the borrower paying again. Well, in this case, they're in Chapter 13. The court has put that into place. So they are paying, and there is Chapter 13. Now, right. If that borrower happens to fail to maintain the payments as defined by Chapter 13, simply petition the court, discharge the home from the bankruptcy, and continue on with the foreclosure. We're not going to try and do a workout because they already tried that with bankruptcy.
And Dale, can you explain just briefly how the chapter 13, why that's significant?
Yeah, so Chapter 13 is basically a repayment. Well, in simple terms, it's the court through the court system, the borrower commits to a repayment plan of debt. And that's Chapter 13 versus Chapter 7, which is a liquidation of assets. Right. So here, and the thing we also like about Chapter 13 is in this situation, we actually have an attorney that we can deal with, right? The person that's handling the Chapter 13. That answer your question, Rick?
Yep.
Okay. All right. So what's next? So this is kind of my little pitch part. Non-performing mortgage notes, in my opinion, provide an ideal option for anyone that has a rollover IRA or a self-directed IRA and they got that money sitting in cash and it's just not producing any returns. Vanguard just did a study here within the last month, a survey of their IRA holders, and they were surprised to learn that 48% of IRA owners just assume that IRA contributions are automatically invested somewhere, and they're not. You make an IRA contribution and you don't put it in something, it's just going to sit in cash. So there is billions of dollars sitting in cash in IRAs, not making any money. My message to anybody in your audience is, even if you are a real estate investor, if you got a self-directed IRA, if you got a rollover IRA that you had at one time, if you haven't looked at it lately, look at it. That's your homework for tonight, is look at that IRA. How much cash do I have sitting there? You could put that to work in real estate, immediately. And what you're going to have to do is you're going to have to you're going to have to move it from an IRA into a self-directed IRA. And if you connect with me, I can point you in some direction. You want a real estate investor-friendly self-directed IRA that knows how to do it, right? So you want a custodian of that IRA that knows how real estate investing works. But if you do that, and if you use this cash out of a self-directed IRA to buy non-performing notes, you're definitely getting above average returns compared to just leaving it in cash. You're completely passive, which is a requirement of a self-directed. If you're going to invest in real estate out of a self-directed IRA, the self-dealing restrictions often throw people for a loop. So self-dealing, once again, means that yes, you can invest in real estate in a self-directed IRA, but you cannot have any active role in managing that property. You can't go cut the grass. You can't do anything. You have to be completely passive. Well, non-performing loans are completely passive because, again, the loan servicing company is doing all the work. These also have unlike other forms of real estate investing, these are shorter term holds. We're holding them anywhere between 12 to 36 months before we exit from the property. 36 months, meaning that, if we have to take it to foreclosure and complete the foreclosure, so it can be 36 months, but then we just exit at foreclosure. So it's a shorter term hold versus buying real estate in a self-directed IRA and you're just holding it as a rental for the next, 20 years. But in that case, you're paying a property you have to have a property manager and paying them and such. Now, I would say anybody that wants to use a self-directed IRA for non-performing note investing or non-performing mortgages, you should probably have at least $50,000 cash sitting in your self-directed IRA or an IRA. But if it's in an IRA, you're going to have to move over to a self-directed IRA. So that's kind of it. That's what I was going to share. I'm Terravest Capital Partners. I'm in Minneapolis. I would encourage anybody reach out to me, Dale at terravest.fund. They're more than welcome to call or text if they have any questions or want more information about it. But I would just leave it as saying that if nothing else, email me, call me, text me, and simply get on my list. That way I can send out notifications when, as deals come available in the future, and we can have a conversation of how do I participate. I think that's it.
Oh, I love it.
Oh, I love it too.
Again, it's just such a different side of the whole real estate spectrum that it just isn't talked about often, at least on the mainstream side.
Right. Yeah. And that's kind of my mission, right? So at least here in the local market, and anytime I can engage with real estate investors on a national stage or a national level, I'm on a mission. to share this information with real estate investors, to just let them know that. And again, the way I'll always say it, especially when I I'm giving a presentation next month to a local real estate investor group, and I always say that I share this with you not to convert you into from what you are doing now over to what I'm doing. If there's interest or what have you, I'll help you along.
For sure.
But within this thing we call real estate investing, we're always going to need wholesalers. We're always going to need people that can do rehabs on property. You don't want me rehabbing a property. I can rehab a mortgage note, but you don't want me rehabbing your property.
Yeah.
You want to keep me as far away from the power tools as you possibly can.
You and I both, Dale.
Right. But I get this part, right? I get the numbers part, and that's where I'm comfortable. And we're always going to need people to hold property, because we're always going to need rental properties. So we're always going to need those landlords. So we all got a role to play.
For sure.
But I share it because I want to open people's minds to there's more than just what we typically hear, what real estate investing
100%.
is. And
Yes.
and once you understand the debt side of real estate and what happens there, the opportunities are immense.
You're awesome, Dale. I so appreciate your time today. This is so educational. This is just awesome.
Well, I mean, who knows? Maybe I end up being your note guy for your podcast going into the future, because I can always share other things in the future. But I just wanted to share this because, again, I am on a mission to try and reach out to, whether they're an active real estate investor or whether it's somebody that has a self-directed IRA or what have you, to reach out.
Start learning the process.
I completely lost my train of thought there, but yeah.
You know what? And I've got something else for you. Don't hang up, Dale, before you. Let's conclude our podcast, and don't hang up. I've got something for you.
Well, gents, always a pleasure. Dale, thank you so much. Again, you might be our note guy. And I do think, just on the two things, I think there's an opportunity for us to get you in front of the sub-2 community.
Yep.
And here's another way, here's a lead source that everyone can feed from, depending on your risk tolerance and where you're at and what your buy box is. But also just on the commercial side, I think there's opportunity for us to partner, and you and Rick can connect on maybe we can be the lending source for those properties that need help. And if there's someone that's wanting to take it over, there's enough opportunity for everyone. And I love having the abundant mindset.
Yeah, absolutely. Absolutely. Yeah. Who knows? Maybe in the future, maybe for a future one, we've kind of looked at overview kind of stuff and bigger picture stuff. Maybe at some time in the future, we look at an individual property and break down the numbers and just show how that works.
For sure.
Awesome.
Cool.
All right,
Thank
guys.
you, sir.
Yep. Everyone, take care. Thanks for listening.
You.